Good morning, and on behalf of myself and the New South Wales distribution team, welcome to Macquarie. Macquarie are very proud to sponsor these events with, in conjunction. Is that Toby in the background? In conjunction with IMAP, we spend a lot of time with businesses across the market, and what we find is that when we're working with businesses on their managed account solutions, the ones that have taken the time and the resources and energy to come to these events, particularly the ones that IMAP run, really have a head start in front of some of the other businesses. So we work with businesses to build out managed account solutions, as well as partnering with investment experts to deliver their managed account programs. And we find that the businesses who are really accelerating in this space have the resources dedicated to the investment solution, and they're freeing up their other resources to focus on personalisation of the client experience. And this is the one thing that our research is continuously showing that clients truly value in an advice relationship. So welcome again, enjoy the series, and we'll pass over to Toby in Melbourne. Thank you.
Okay, so we're going to... All right. Now, can you see me in Sydney?
Yes, we can hear you, Toby.
Okay. Now you're running the slide. That's great. So you're running the slides, I gather. So you guys have got the clicker in Sydney.
Yes. Thank you, Toby.
Okay. Thanks, Bianca. Look, welcome everybody, and thank you, Bianca, and to Macquarie for providing the facilities for this investment forum. This is part of IMAP's series of investment forums where we try to get, as Bianca said, because of the growth in this area, we try to bring together both the investment professionals who are involved in making the investment decisions, together with the advice professionals and the research teams out of the licensees who are involved in implementing these, because managed accounts really is that sort of nexus where the investment process and investment decision making hits the advice process and advice decision making. And this investment forum seems to us to be a good informal way of drawing the threads together and making it clear the intersection between professional investment decision making and advice. Before we get going with today, which is Andrew Stanley from Ralton Asset Management and Patrick Nalty from Paradigm Wealth. I wanted to talk a little about, back to the, thank you. I wanted to talk a little about the activities which IMAP has coming up this year. So in August, last year we ran for the first time our portfolio management conference, and we'll be repeating that again. So we had between 200 and 300 people at the conference last year, and it was a real success in trying to draw out the issues around investments, because the decision-making process around investing, when the outcome is, mum and dad's $500,000 portfolio rather than a pooled unit trust with 50 million, the investment decisions are different. The investment committees are different. Different people are involved. And so the Portfolio Management Conference really focuses on the nuts and bolts of how investment decisions are made, what type of decisions can be made, the constraints and of course, the opportunities for operating in this type of financial service. Alongside the Portfolio Management Conference, really exciting for us, is the first of the IMAP awards. So that'll be on the 1st of August. And the goal, again, is to recognise what best practice looks like in a managed account environment. So the awards focus on the investment aspects of managed accounts, and there are the usual categories of Australian equities and fixed income and multi-asset class. But more importantly, we're really focusing on the licensee portfolios. So how do licensees ensure that the managed account program that they offer their clients is best practice, and the awards are really designed to recognise best practice at a licensee as well as at an investment level. On the 9th of May, we'll be running a webinar at lunchtime implementing a private label with NetWealth as the presenters in that case, and then later through the year we run other events. Perhaps we could go forward to the next slide, which is the Portfolio Management Conference, as I say, 2nd of August, full day conference in Sydney at Dockside. Perhaps to the next slide. So here are the sorts of topics which we covered last year and some which we've brought from last year through to this year. So investment lessons we learned. Last year we had Clearview and IOOF talking about their 10-year experience of setting up managed account programs, in one case an SMA and the others MDAs, and the investment lessons that had taught them. ASX exposure, I think, is an interesting one. The Future Fund has a 6% exposure to the Australian market. There'd be a lot of private portfolios out there which are in excess of 50%. Investment Trends, at a presentation I was at yesterday, pointed to significant number of portfolios which are over 50% Australian equities. Now, one of these guys cannot be right. And so we'll draw out that theme of what should home bias be. I'm a New Zealander, and I can tell you home bias in New Zealand is don't invest here, it should be offshore. The usual sorts of topics. Let's move on to the next slide. So today, our first presenter is Andrew Stanley from Ralton Asset Management. Andrew's the head of portfolio management for Ralton, and a long-standing investment manager with them. Today he's going to talk about retailing stocks in Australia and the advent of Amazon in particular, but technology drivers in more general terms, and how that might impact on the composition of a portfolio. Following Andrew's presentation, Patrick and I will be talking about Paradigm's experience of over a decade of using MDA services in his practice, and we'll draw out the themes that he's learned. So without further ado, let me hand over to Andrew in Sydney. Thanks very much, Andrew.
Okay, good morning. What I'd like to take you through this morning is an overview of the Australian retail sector, and perhaps not just focus on the discretionary retail stores, but extend that out to think about consumer staples groups and the property trusts, which often interest people as well. Because the changes that we're seeing at the moment in the retail landscape, both at the household level within Australia, but also because of the arrival of Amazon and other online providers, means everything is in a state of flux. So the arrival of Amazon in Australia is going to shake things up. It's going to change the way people have to operate. And the smartest operators in the industry are already underway in getting organised for them coming. But it's fair to say that Amazon is already having an impact in Australia. Does anybody remember Barnes and Noble or Angus and Robertson, who all disappeared years ago? Just to give you if I have to leave you with three things to bear in mind about Amazon, or takeaways about Amazon, it's number one is price transparency will increase. Okay, you'll be able to go to your mobile phone and check the prices there instantly and look at what they're going to charge you in the stores. Secondly, the cost to serve in the stores is going to have to come down, yet we actually need more customer service. It's going to be an interesting one for the retailers. and the customer experience has to be enhanced. You actually have to be giving them more, give them a reason to come into the store. So today what we're going to do is we're going to look at our framework for how we actually think about the retail sector, first at the macro level, and then honing in on some of the issues that are thrown up from Amazon. So if we start with what the retail drivers are, the critical one, of course, is the level of household disposable income growth. Now, it's difficult to see on this graph, but what it's highlighting is in the period from 2000 to 2010, real income growth in the economy was running at about 4%. For the last 2 to 3 years, it's been running at 2%. A halving like that in the rate of income growth is actually a material change. Okay? It really is a big slowdown. Now, what drove this? It was actually the commodities boom. If you all recall, Peter Costello at first and then Mr Swan used to turn up and tell us there's been this big influx because of the increase in price of iron ore and coal. Australia got this income benefit and the government distributed part of that to us. So we all got this free kick through tax cuts for many years. That's all now over and done with, and the government's now got to fix their budget, and so that's crimping spending. The other thing that's crimping spending is rising healthcare costs, rising energy costs. So the retail sector has really been under pressure around this. The RBA is holding out some hope that there will eventually be a rise in wage growth. We can't see it being particularly steep because what you actually need is more productivity growth in the economy. That's the way we get people back to a more solid level of income growth, and we just don't see where it's going to come from. Secondly, the other thing that households can do is they can run down their savings rate. Well, as we can see in this graph, they've already run it from an average of about 8% post-GFC down to about 3% from 2016 onwards. It's steadily been coming down. So we've tapped that one. There's a bit more to go, but it's hard to go terribly much further. The other thing that households, of course, do is they tap the family home, which has been going up in value for a number of years for equity, whether it's to buy cars or do furnishings, new carpets, renovations, that sort of thing. Again, we're at historically high levels of household debt, so that is going to crimp the capacity for households to go further. On a positive note, we've actually seen a very rapid rate of migration, particularly to Victoria and New South Wales over the last few years. More people coming into the country make traffic worse, but they actually are good for the retailers. And as we've heard in the last few days, it doesn't sound like we're going to get a cut in migration, although then there's another story this morning saying it's already underway. We're seeing a trimming for those that have looked at the papers. Then on to another area, and that's the impact of the level of housing sales in the economy. The turnover of the housing stock, interestingly, actually drives retail sales in the Australian economy. And that's because when you move into your new home, what do you want? You want new curtains, might need new furniture because your old table doesn't fit, new electricals for similar reasons. It's a point for people to actually update their goods. And what we've seen over the last couple of years is that rate of turnover coming down, and of course there's a segment of the retail market servicing that have been under pressure as a result. Another area where we see an ongoing, where there's going to be changes is this ongoing shift away from shopping in store. Okay, Euromonitor has prepared these graphs, and what they're saying is that between 2015 and 2020, it's expected that there will be growth in retail sales of around 5%. Now, we actually think that's too high. We think it's going to be more like 3 to 4% for a number of the things that I just highlighted to you. But the second graph, the interest in that is they're saying that online sales are going to grow at 11.5% compound through the same period. That we very much would agree with and think it may even be faster than that. So what that's telling you is that the old bricks and mortar stores are going to have to restructure, or the owners of those are going to have to restructure, and we'll see more sales coming through the online. But there are things when we look at Amazon that need to happen in our economy to actually adapt to that, particularly around the cost of the last mile of delivery to the home. Okay, so what are some other drivers of success for retailers in this day and age? The first up is the capacity to keep up with the new trends that are coming in the market. We've seen a number of the international brands enter Australia, Zara and the like, who are very much into the fast fashion. So the Australian apparel retailers have had to adapt to that and make sure that they're bringing new, refreshed product to the stores every 6 to 8 weeks. Another one is in Australia, we've got a very concentrated level of ownership in the major shopping centres. So many retailers need a position in those big centres, one from a branding perspective, but to also drive sales, but it actually comes at a very hefty rental cost. And the final one there is the retailers have to keep up with changing service demands that people have. For instance, the younger generation want to be able to look online and then come into the store and get advice, which my generation, I think, have been prepared not to be able to get. If you think about the big department stores, the younger generation just won't tolerate that. Okay, and finally on the retail sales drivers, I thought I'd just touch on it's often talked about that we need an omni-channel retail offering. What does omni-channel retail offering mean? What it is it's your digital capability. It's your ability to have a web service available, whether I'm on my mobile phone, my tablet, or my computer. It gives me an experience, a friendly user experience in each environment. The stores, they have to be modern, fresh, uncluttered, with good customer service. And there's got to be a range of delivery and collection options. So you might have seen recently Woolworths has moved to click and collect at all their supermarkets across the country. There's a range of groups moving to that sort of offering, and that's what's all caught up in this what's termed omni-channel offering. And this slide I've taken here is from Super Retail Strategy Day last year. And the interesting part to note about it is if you look at the top boxes, that's the size of the physical market, the in-store sales. They're effectively saying over the next 5 years, they'll take market share, but there's actually very little growth in the actual market. If you look at the smaller side, all the growth is actually going to come through the online and delivery to person channel from their perspective. So look, as you can see, even without the arrival of Amazon, there are actually already a number of headwinds for the domestic retail sector. And that's not to say there aren't people that have, players that have not done well during this period, but you've had to be far more discerning about the ones you actually pick. Okay, so just now having a bit of a think about what it actually means with Amazon coming into the market. If we look at, for all the hype and talk about them, they actually only represent 2% of US sales. it's actually quite extraordinary when you think about it that a company with such a small, seemingly small total share gets so much airtime. But it has fundamentally changed the way retailers operate, and it's a structural shift and not a cyclical shift. This won't turn back, in our view. So a few of the impacts of Amazon coming into the market, just to give you an idea on it. A few categories will be untouched. You know, they've been able to adapt in a whole range of different ways into the market. Amazon always innovates. The days of starting a new retail concept, starting with 50 stores at listing and saying you're going to grow to 300 and you just roll out exactly the same model for the next, 5, 7, 10 years, those days are over. You are going to have to be continuously adapting to what's going on in the market and innovating, because the competitor that's going to eat your lunch is doing exactly that. We'll all move to, for those that already don't, we will all end up moving to examining everything on our mobile phones to check whether or not you're getting a good deal or not. I know if I go through duty free, I always go to the Dan Murphy's website and see whether or not I'm getting a good deal or not as I go through. So price transparency is going to become a fact of life. And the good retailers are the ones that are going to survive, have already started to adapt to this changing environment. When it became apparent that Amazon were going to enter the Australian market, we actually sat back and had a think about it. There was a lot of research coming out from the brokers and whatnot, trying to tell people what the valuations of the stocks were going to be based on international experience. And that is all useful information, and it's probably your starting point to go from, is to look at what happened elsewhere and what could happen to margins, say, for a retailer and the growth in sales. However, what it doesn't do is it doesn't give you a mechanism to actually analyse and think about whether or not a company is actually going to be able to deliver on that valuation in an evolving environment. So what we did was we actually developed a framework for how we were going to think about retailers in a broader sense, including consumer, the big supermarkets and things like that, and the brand owners as well. The first, so what I'll do is, I won't touch on the valuation side of it, I just want to go through this framework. The first part of it is you've got to have management capability. You know, this new environment requires skills in logistics, data analytics, hiring the talent for that. It's not just about starting with 50 stores, growing to 300, training all the people in the same service standard. That's gone. It requires a new skill set. Second one, as I mentioned to you, is a change in the level of price transparency. I'm sure we've all got illustrations of things that annoy us. I get annoyed by going into Rebel Sports and seeing ASIC Kayano runners at $260. And if I go on to Foot Locker in the US that won't ship out here, I can buy the same runner for $140. Yeah, those sort of anomalies are going to end up being competed away with Amazon. The logistics chain. Amazon has revolutionised the way logistics are done globally. The days of an old box with people running around inside are gone. For those that haven't actually seen it, there's some YouTube videos online of the robots that they have running around in the warehouses to collect items to bring back to the centre, which is interesting. Prime shopping centres are going to be a beneficiary as well. Why? Because you're still going to need your brand presence somewhere, but you don't need as many stores ultimately. Data analytics. Amazon, as we've heard about Facebook recently, collects all sorts of data on you. Amazon's doing exactly the same thing, and they have teams of data scientists that are actually examining it, working out what to put in front of you individually. The retailers here have been collecting data, but they haven't actually done anything with it. So they've got to start doing something with it. Customer service. Amazon's customer obsession, if you like, will force everybody else to adapt. The days of walking into a store and wandering around for 10 minutes trying to find someone to help you are going to be gone, because those stores that do that just won't exist. And another one is CapEx and working capital. So companies, to survive through this transition period, are going to need strong balance sheets. Why do they need a strong balance sheet? The odds are there's going to be stores that have to be closed. Most retailers will have a top 20 stores that do really well, and then there'll be a long tail of sub-performers. That tail is going to have to be cut off, and that's going to have costs for them. And also, a lot of retailers, you may or may not be aware, operate with negative working capital, i.e. they pay their vendors on 90 days, but you pay them on 30 days through your credit card. So that means actually restructuring your business and losing sales from certain stores actually has a working capital impact. So they've got to have enough balance sheet to deal with that. And the final one is you've got to be able to get the staff to work with you. And what I mean by staff, I mean it's the PhD mathematicians, economists and behavioural scientists to actually work with all the data and new information you're going to get, and to work with your logistics chain, optimising your logistics chain and things. Those people don't exist in Australia. Amazon is actually having to bring them in. You can't hire them here. So that's going to be a challenge for people. So when you're looking at Amazon, there are a range of international precedents of people that have actually succeeded in responding to them. If you think about it, you know, electrical retailers were one of the classic squeezed in the UK and the US. And of course, what the vendors of electrical goods discovered is they don't want to just be dependent on Amazon. So there is now an incentive to keep your JB Hi-Fi and your Harvey Normans in business. They don't want to see them crushed, because otherwise their only customer's Amazon. So your product providers are in this with you as well, to a degree. But some of the defensive strategies include, you know, having specialist product offerings in a niche area that actually require trained, you know, that with good training, your sales staff can actually sell to and or upsell on product. Attractive loyalty programs. You know, sure, everybody's got a range of different cards now in different places. That's doing two things. It's collecting data on you, and it's driving you to keep coming back to them. And others will adapt by simply using Amazon's sales portal to actually drive their sales further. They've got a niche product, and they just simply use Amazon as the way to actually sell it out into the market. It's fair to say that Amazon won't have it all its way in Australia, where, you know, the first one I've got there, the political backlash. These are big employers, and there are being complaints. If you actually have listened to Donald Trump, I know people might want to, but this was a good point the other day. You know, it is actually crushing employment. It's, you know, taking unfair advantage of people in certain ways, and they possibly do need to be regulated. You can be pretty sure, you know, in the environment we've got in Australia, I think there's a move pretty quickly to stomp on things that are seen as anti-competitive. The logistical challenges in Australia. Australia is a bit like Canada. We're actually very sparsely populated, other than really Sydney and Melbourne, in terms of what Amazon traditionally has worked with. In Canada, they've really struggled to get much market share. I think they're at about 11% versus, say, 25% in the UK, where it's more concentrated. So it is going to be more difficult for them to work out how to solve that last mile delivery problem here. competitors can respond, as I highlighted before. There are plenty of precedents internationally, and a strong and timely response in particular categories, and I'd put our supermarkets as somewhere they'll struggle against in Australia. And the final one is there's an interesting difference between the competition laws in Australia and in the US. In the US, Amazon's put a range of operators out of business simply by selling product at below cost. So there were baby care product providers. They wouldn't sell out, so Amazon simply dropped the price of nappies to making a loss on every one they sold, wiped the competition out, and then increased the price of the nappies. In Australia, you're not going to get away with that. In the US, what they're doing is, provided the consumer isn't suffering from a price perspective, the regulator won't step in. In Australia, if you price below cost to drive, it's assumed you're trying to drive your competitor out of business, then the regulator can step in. So Amazon is going to have to innovate in the Australian market to compete. Just to touch quickly on how we're thinking about the market. Obviously, at the moment, we're running negative screens, right? There's pressure on the overall level of retail sales. So we've got to keep that in mind. And without knowing fully what Amazon's going to deliver, we actually have to assume they're coming with a full product rollout. In the supermarket area, we're a different market to some of the others where there have been online operators get in. No one's really done it successfully. It's just too expensive to make delivery work. Ours is a very concentrated market with the top three players having about 75%. That 25% tail will keep losing business, but there's enough in there for Amazon to take and the others to keep growing. And Woolworths and Coles both have the balance sheet and capacity to adapt, and their management teams are focused on it. In the A-REIT space, centre quality is going to be the key differentiator. Centres like Chadstone in Melbourne are going to become more valuable to be in because that's where your branding takes place. The pressure will remain otherwise on specialty store rents because their capacity to sell through these centres is going to go down down. But the use of data analytics and different entertainment experiences at shopping centres are what's going to bring people back there. And the good ones we're seeing already move down that path. In terms of the discretionary retailers, the good ones need to move fast on a range of fronts. And as I've given you a framework there for just thinking about how to deal with how we think about those. Just lastly, I thought it was interesting. I was originally asked just to talk quickly on the reject shop. It's done really well. It's actually doubled in the last couple of last 12 odd months. The thing about it is that it's still trading below where it was in 2011. So on most fronts, it doesn't actually meet our requirements because it doesn't have customer loyalty, its own products. It's getting swamped by Kmart and Aldi from different directions. It doesn't have a good supply chain. It's too small to compete. So look, my time is up, so I'd better wrap it up there. Thank you for listening.
All right, look, thank you very much. So Patrick, do you want to join me at the, now, to make sure that these work? You need to, yep, that's it, I think. Yep, put it green on. Now, can you hear us in Sydney and Brisbane?
Yes.
Great. Okay. Look, it's my pleasure, and more to the point, can you see us, I suppose? But right, okay, cool. Right. Well, pending being able to see us. All right, pending being able to see us, it's my pleasure to welcome Patrick Nalty. James told me that he'd had his hair cut specially for the occasion, so the new slick improved version of Patrick Nalty. Patrick's the CEO of Paradigm Wealth Management, a long-established Melbourne-based advice practice. And so I thought what we might do is start off, Patrick, by you telling us a little about Paradigm.
Sure. We're an independent wealth management firm. We look after about $500 million worth of people's individual wealth, and that's spread over about 450 clients. We've got three major offerings. One is our investment management offering, which is fundamentally through the MDA. We have an advice offering, which is a fee-for-service advice business, and we run a self-managed super fund, compliance business, and technical resource business for accounting firms. So that's makes up the core of our business profile.
And so, would a typical client be a client of sort of all three of those components, or two out of the three?
No, typically would be a client of all three components. And we have a technology solution which sort of marries it all up together across the three of them as well.
Technology which is designed to achieve what, Patrick?
Efficiency of scale, and that's why ultimately we went into this MDA space. I mean, what we've always tried to do with our business is try and drive efficiency. Like human resources are the most expensive. It's where things go wrong. The more sort of humans seem to touch things, the more issues you tend to have. So what we've done is try and go, we'll have an MDA solution, and we'll talk about that in a minute. An advice solution, which we've got some proprietary software written for us through Xplan, and we use Class through running our self-managed super fund administration. The whole three parts of the business all talk to each other.
And so just before we move on, in terms of human resources, how many advisors and other staff in the business?
Total advisors, we don't run a dealership. We are, all our advisors are salaried employees. We've got 6 advisors across the organisation, and we've got about 12 support staff that support all that. So.
Okay. So to move on to managed accounts then, tell us about the managed account service, the MDA service that you use, and how long you've been using it, and the type of service that you offer.
Well, it was, we instigated this in 2009, so not quite a decade, but 2009. It was fundamentally driven out of the GFC. Like James and I, we've been together a long time running our business, and we had a house view that, running up to 2007, 2008, that the market was somewhat overheated. We've been having stellar returns for 10 years, 20% annualised every year, and we thought this can't last. But remember we were a financial planning firm, and we went, well, what do we do? Like, we've got to do a statement of advice or a record of advice if we want to shorten the positions. There has to be a better way, because we thought, do you start with the A's or do you start with the W's in trying to sort of work through, because you didn't have any discretion over the client's account. So you actually had the approval if you wanted to turn more, you wanted to redeem investments in a BT wholesale sort of fund, and you wanted to redeem the investment in that and go more to cash because that was your view. You had to do a statement of advice or a record of advice. And a lot of our clients are retired or semi-retired, they're travelling. So we just thought, so we did nothing. And we just had to sort of tough it out. And then we said, right through that process, we thought there has to be a better way. Like, what's happening overseas? And I did a lot of reading about out of America. And I'm thinking managed accounts in the States was huge, and it was only very, very small in Australia. In fact, you were early days at that time, and there wasn't very many providers as well, and we said, well, how can we have a process which allows us discretion over the client's portfolio, which allows us to form our house views via our investment committee, and then act on them without having to do a whole raft of, compliance type paperwork. And that's sort of fundamentally why we went down the managed accounts path.
And that drew you to an MDA solution.
Yeah, and we went too because, Toby, you worked for them. There was IAS in those days, and there was very little providers. You were very helpful in the early days, and so we ended up with managed accounts, as they're now called. It used to be IAS, and we just did that using, because we liked the model portfolio approach, and we liked the technology that was allowed, going to take a lot of the heavy lifting over the way we historically ran our business. And historically, we had our clients in master trusts, we had them in wrap accounts, and also we had a bunch of discrete portfolios, which, for want of a better word, we might have run it like as an IMA. We were running it off spreadsheets, we were doing the corporate actions, we were doing the buying and the selling. Like in the corporate actions, particularly post GFC, where there's a lot of capital raising going on. Like we were getting mail and corporate action prospectuses and the likes by the 12 bags would roll up at reception, and you'd be writing 300 letters, 400 letters, and it was just a nightmare. And we thought, well, again, one of the efficiencies the MDA allows you to do is by appointing your best of breed managers to run them. They take on all that corporate action, and it also stops clients missing out on the corporate actions because they've got the decision-making process to go, well, shall we take up this capital raising or shall we not? So it drove a lot of those.
And so with the with that sort of 9-year span now, what proportion of your clients now are in a managed account?
Probably 80%, I would say. 80% would be in a managed account solution. We've still got clients that we don't really get pushback across, but there are some clients where it just doesn't suit them, and it's not, it doesn't meet their profile, and you've got to be careful because you are getting your clients to give you the discretion, and some people are still prefer, because it needs a degree of sophistication from your client as well to adopt and go into this process, and a degree of trust from the client. So there are still a portion of clients, and there's also some assets that, for whatever reason, they're unlisted or whatever, and they can't be picked up on the administration on the managed account. So we do keep them as a discrete portfolio that sits outside the process.
So let's talk a little about the investment process then. So and drill a little more deeply into that. What is the Paradigm investment process?
Well, and this is, I counsel anyone who's thinking of going down the managed account process, is that you've got to give a really good, solid thought about the way you're going to run your business. Because what we fundamentally have gone through, we've actually moved from being, a planning firm that did some investment work to we are now an investment manager that actually has the ability to offer an advice solution. So it's actually it sounds subtle, but it's not. It's actually a flip on its head, because if you're going down this route, you are getting yourself appointed as the investment manager. And as the investment manager, you've got a certain roles and responsibilities that you've got to adopt. So first thing we did was set up a truly independent investment committee. And we went to a lot of work to try and get the right calibre of people to sit on the investment committee. We are only attendees at the investment committee. So we've got like Ken Atkinson, who owns Towers Perrin, sits on our investment committee. Martin Ryan, Ostock. Mike Hawkins, ex-CIO of Evans Partners, and Paul McGlynn, ex-UBS. So they sit there and take a macro view over the world and where it's going, and then we run model portfolios, and their job is to sort of like work with us to find who are the best of breed managers for the 5 discrete portfolios that we run, and that is an Australian equities portfolio, an international portfolio, a diversified fixed interest portfolio, an alternative portfolio, alts, and what we call a transition portfolio. The transition portfolio is that not every client is going to fall into the model, so you've got to be able to have some flexibility that if they don't fall into the model, they might have, inherited 500,000 BHP shares from their granddad or something like that. Now, that's not going to fall totally into the model. There'll be a portion that sits in that. So the role of the investment committee which operates under a charter, is to fundamentally sit there and keep those managers honest, to make sure that because they're all under mandates, and the mandates have been worked out between the investment committee and the managers as to the actual process that they've got to adopt. And it might be you can only invest in the top 50, or you can invest 80% in the top 50 and 20% in the ASX 300. So the mandates, and then they are managed to make sure that they keep managing that process.
And the types of well, just to touch on the investment, we'll stay on the investment committee for a minute. The investment committee, and you mentioned its composition, that's essentially the voting members.
Yes.
And the Paradigm management is attendees and sort of...
We are attendees to the committee. We can sit there and put our preferences in, but it makes it a very interesting process. And it actually, just as an aside, our PI insurer, which was really nervous in the early days about us going into this MDA world, and now who have got, that's another thing. I'll digress for 1 second. Like, if you're going down this path, engage with your PI insurer so they actually know what you're doing and how you're doing it, and they become familiar with your business, because initially there was a resistance because, well, you've got discretion over the client's portfolios, whereas you didn't have it before. Because you're kind of moving into a different compliance regime that they might not necessarily fully understand or be comfortable with. But they know now that, and it's interesting when you meet various BDMs on the journey, business development managers, and you sit there and go, well, yeah, that's interesting, your proposal, but you're going to have to take it to the investment committee, which is made up of these 4 gentlemen, so you better be on your main game because you're going to be under the pump. Well, it's interesting that half of them never make a follow-up appointment. Yeah. And the other half do, and they come very well prepared. So we, as management, James and I, we can sit there and go, look, we'd like to have this theme in our portfolios if possible, but it's up to the investment committee that actually, either approves or disapproves it, and then, manages that process and makes sure that they are, keeping themselves true to label what they've promoted.
And so those 5 portfolios that you mentioned, there's a mandate document for those.
Correct.
And that's...
Yep.
Essentially, the investment committee's operating to that.
Correct.
mandate.
And if they don't operate to that mandate, they're giving a warning. And if they still don't operate to that mandate, they'll be removed. And that's one of the great joys about a discretionary account, is that, fundamentally the portfolio still stays in, the beneficial ownership of everything stays with the client. And you can appoint a new manager who comes in and takes up that existing portfolio and then moves it back into the mandate that is being granted, and then takes on the role of managing it. So it keeps the manager really honest, because they know in a click of a hand, 24 hours later, they're removed from managing that mandate. And we've got people out there now running mandates for us over $100 million. So.
And so what's the composition of the portfolios in terms of directs versus funds or ETFs or fixed income investments?
Well, even our fixed income investments is run as it's a diversified portfolio. So we still, by the power of volume, we do get the ability to buy governments and semi-governments and the hybrids and all of those things. So even that is made up, but it's fundamentally 80% of that portfolio would be in some level of direct. And 20%. So international, we use fund managers for the international side of the things. We use a couple of fund managers for the alternatives. Otherwise, it's fundamentally direct investments. And again, until Bill Shorten gets in and starts changing things, the ability of being able to be, direct and have, your Australian equities getting their fully franked dividends, going through into people who are allocated pension phase, get the full use of, the cash refunds that come out of the unused franking credits. And
actually, to pick up on Bill and the prospect of that, I've been thinking for the Portfolio Management Conference that we would actually run a topic on how investment committees respond to these sort of exogenous events, where Bill Shorten says, franking credits might be gone for this class of investor. So let's hypothetically say that happened. How do you think your investment process, and I'm putting you on the spot here, but how do you think your investment process might respond to a situation where some investors can get that type of benefit and some can't without sort of running the ship up on the rocks?
I'll answer the way Bill would probably answer. Thank you for your question. It's a very good question. I'm glad you've posed it. Again, that will be, but we will honestly, the investment committee will then have to rethink, you know, with that class of client that has become reliant on, you know, the enhancements to their portfolio of you know, the franking credits. We'll have to have a good solid look at, you know, what it'll do. It'll force us into probably in some respect, you know, going up a little bit higher up the risk curve for the client. Because it's not going to, the investment process is now not going to be around, well, you know, we'll pick some good, strong Australian companies paying fully franked dividends. It's going to be, well, what are the other options? And it might be we take a greater exposure into international markets, for instance, because, you know, you can't get franking credits in international, but the ability to get maybe stronger returns out of that market exists. But, you know, I can't second guess the investment committee because their role is to work with us to come up with these solutions. And that's the whole joy of having a strong investment committee, is that you've got some good people who are involved in your organisation, and we pay them for it. They, you know, it's not a free service. They come along, and you know, it's a solid every 2 months. It's a solid 4-hour, 5-hour session whereby they take a good, strong view. So I'm sure that will be ongoing debate. But first, Bill's got to get in there. You know,
and then in the meantime, the actual security selection decision to buy this, sell that. You know, and Andrew Stanley, for example, saying we're out of Coles or we're into JB Hi-Fi. That decision making carries on.
Well, we use, you know, and it's just by pure coincidence. Well, we use, one of our managers is Ralton, and you know, and that's a mandated portfolio that is run discreetly just for Paradigm clients in the model portfolio. It makes up, you know, part of the Australian equity portfolio, and that's his role. It's Andrew's role to go through and make those decisions, and you know, but he's got to run that inside the mandate that is set for them. But that's their role, and that's his decision. And the good thing is, because the clients actually have the beneficial ownership of these direct equities, and because our clients, as I said, you know, 450 clients, 500 mil, average client size is over $1 million. They like to look at their portfolios and see that they've got, you know, what shares they're holding. It's not sort of, you know, you've got, you know, 200,000 units in, you know, some fund. It's actually they hold the discrete individual stocks in that portfolio.
So do you think clients?
Just on that, but they actually see, because they can look at their portfolio and it's because a lot of what we do is psychologically as well. So they see that there's active management in their portfolio, because as Andrew said, like we've sold JB Hi-Fi and bought Amazon, and then and Andrew helps us, you know, we put some dialogue around that. So, you know, if there's a major move in the portfolio, they see it because it's online, and they see the movement in the portfolio. So they see that, you know, that their advisor is constantly doing and working on, you know, managing their portfolio for them.
On to that very point. So do they? How do you think your clients kind of compartmentalise the job their advisor's doing, the job the Paradigm is doing, the job that underlying investment managers are doing, and how do you articulate who's doing what?
Well, this is this subtle shift. We were a financial planning firm doing, you know, investment work for the client. We're now more of an asset manager with the ability to have an advice capability to it. So we're finding the majority of clients, and you'll find this as the size of your clients gets bigger, they're not necessarily don't want the whole financial planning process. They don't want to go, well, you know, what do you want to retire on, and let's see if we can, you know, get you there, and let's do a budget, and, you know, let's work out, you know, some of the I suppose, a peripheral that goes around the advice side. They come to us now more like, you know, we've turned out to be very good at being able to manage money with the scope of the investment committee and the fact that we can move managers around and, you know, we can tactically weight clients on their asset allocation. So the role of the advisor in our organisation is to get the asset allocation correct. So they are constantly working with their clients to work out, well, what's your attitude to risk, your risk profile, and then if there's advice capability that is required, we charge that as a one-off discrete advice fee. So you want estate planning, we'll quote it and then charge you the fee for that. With the idea that they see us, you know, managing their wealth, and we keep them well informed as to what process is going on in their investment world. And we have found that's a fundamental shift that you find when your client bases get bigger and bigger. Like our largest client we look up, we've got 45, 50 million in it. And he's just more interested about, you know, what's happening on a sort of a weekly sort of basis in his money.
And how do you, who's responsible for managing the client communications process? You mentioned before we started today, you're looking for a comms manager. So,
yeah.
So what is the comms process in Paradigm?
Well, at the moment, it's fed through, and, you know, we were having a discussion the other day about, like, we're doing newsletters, and someone said to me, that's so yesterday, Pete, you've got to get out. It's more, your clients now are looking for a more tailored solution that they individually felt to be more important. Like, we've just gone through a process while we're down to 450 clients, is that we just got rid of 737 clients. So we just got rid of a tail. Because we want to sit there and have a more, which is, like, it's been a bit ad hoc up to now, which is why we want to go, and we're looking for a comms person whose sole role will be, when there are these movements inside their portfolios, that, you know, those people who are holding, you know, BHP shares, which we've sold to buy Rio, for instance, there is a discrete communication that goes out to those clients as to why the investment manager has decided to change. You know, like some of the information that Andrew was just giving, some of the thematics, the thought process, I call it the golf course conversation, and we found that, you know, a lot of our clients like to get up on the, you know, they're just warming up for their putt and everything else and go, well, my advisor's just sold BHP to buy Rio because, you know, coal fire's going and iron ore prices up, etc. Whatever it is, that they've got some sort of information as to what's happening inside their portfolio. At the moment, that's fundamentally been handled by the advisor, and the advisor, you know, having constant communication with their clients. But it's been certainly ad hoc, and again, a little bit what Andrew was saying, we're moving to making sure everything that we do is web-based as well as, you know, mobile phone-based, tablet-based. So we're moving our technology to make sure that all those things, and we want to actually get it to the point of, like, there's a push notification if something happens, there's a push notification that can go to their mobile phone so that they can see exactly what's happening on their portfolio. And, you know, we get more into the 21st century type of communication style.
So if you, I know you've spoken a little about expanding the business. So if you do expand and take in a new advisor, a new practice, how do you think you would incorporate that advisors' clients into a managed account?
Yeah, well, we've already done it once. We did an acquisition. 2 years ago now, and have migrated a significant number of those clients' portfolios into our managed account service. We're in the process of doing another acquisition, just finalising that now, which will add us about another 300 odd mil in that acquisition, which will push us up to about 800 odd mil of FUM. And again, these are people saying to us, we wish we'd adopted a managed account process. We have found the compliance burden to be, you know, becoming a lot more onerous. We are finding a whole swag of inefficiencies in trying to manage the client relationship with their investments at the moment. So, you know, we don't go and take on an acquisition or expand unless somebody's on the same journey as us is actually going. And we all know that managed accounts now are starting to become very flavour of the month, but we won't go on that journey till people know that is our process. Our process, because we can't run and we don't want to run, and we're quite hard and fast in it, old school money or in the old way, because we've been down that path. It's inefficient, it's time consuming. You've got a massive compliance risk in it because you can't actually guarantee that everything you say you're going to do has actually been done. Whereas through a managed account service, you actually know that when a corporate action's done, it's done for everybody. It's not like, oh, geez, I forgot to tell him and he's just missed out. So it does pull in a lot of tightness into your processes.
Now, are there any questions? Stephen, so question.
Say the $300 million book comes on and they're a fair way different from your model portfolios.
Yep.
That's a fair burden to get that transition in.
Yep.
So just in case you couldn't hear in Sydney, Stephen's question was, in taking on a new book that's a fair distance from the existing paradigm models, what would the process be of closing that gap?
We've, having gone through this now twice, once with our own original client base, then with the acquisition that we did 2 years ago, and now with this future acquisition, we've got kind of good at it. So, and I'll enlarge on that, is that, like, and I know it was sort of one of the things that we spoke about, so I'll jump to it. Like, you don't want to take on the process of transition until you've really got your ducks lined up. You've really got to know what are the processes that you're going to have to go through to transition someone out of an old portfolio. There could be capital gains tax implications on it. There's, they could be all, broker sponsored. You've got to work right through all of that. You've got to be really dogmatic, and you've got to be really accurate in how you're going to run it. So we're lucky. We've got 2 staff people who've been with us a long time. They've been through the whole process, and they'll just take it on board. Because you've got to do SOAs for every client, et cetera, et cetera. So the process. Now, we have gone, prior to this acquisition, we have actually taken them through the process and saying, this is what's going to happen. And, they've already identified, they've gone, well, out of the 300 mil, we know there's 100 that we'll be able to do relatively simply, and probably the other 50 will be difficult, and the other 150 we'll get over a period of time. So we've actually, as I say, out of 500 mil, we've got 300 mil in our process. And, you've actually got to, you've got to be really quite, what's the word I'm trying to find, is it's not as easy as what a lot of people will make out. But once it's done, the efficiency gain you get out of your business is massive. So, and it also depends on how you've been running your portfolios historically.
Would you say it'd be a year in the journey?
Yeah, be a year.
Yeah, so the question was it a year? And the answer is yes.
Yeah. Hello?
Yes.
How do you transition into the IMAP? How do you transition in the managed accounts? You're in the old system, but most financial plans have to,
So I think the question is, how do you transition into an MDA, I think is the... Yeah. So the question is, how do you... what's the advice process that you go through?
Well, first thing you've got to do is find out who's going to be your provider, your administrator, who's going to license you. Because remember, under a managed account, in an MDA world, if you don't have your own, if your license doesn't allow you to operate an MDA, you've actually got to become licensed under, the institution's license capabilities. So they've got to actually go through a process and go, with us with managed accounts, we've just got our own license, but just prior to that, we were under managed accounts. Managed accounts licensed us to use their license to give advice to clients under an MDA regime. So the first thing you've got to do is find out who your supplier is going to be. So who's going to be the best of breed that's going to suit you. And for doing that, you go, who's going to invest money in technology? Because we deem it now to be a technology play. So you've got to go, who's going to have really good, strong technology that's going to adapt into this marketplace? So don't worry about going there yet, because you won't get your own. It's a big task to get your own managed account license, but prior to that, you've actually got to go through a process of finding the administrator. So,
Hi, Pat. You spoke about the clients with the new acquisition, perhaps the 100 million that you think's okay, 50 maybe. What about further down the path? how do you then sell that process to the client? So you go in, the client's sitting there, they're part of PWM. They've had a structure for a while that they've used, that they're comfortable with. Now you come in and say, well, hang on, this is the way we're going to do it. Well, how do you give that to the client?
So the question for Sydney and Brisbane is for the new clients who are being acquired, what does Pat think that the sales process of moving from where the clients are today into the managed account service will be?
Well, our process around the investment side is 10 times more rigorous than what it ever was before, because before we were relying on BDMs, broker research, master trust, wrap accounts, managed funds, etc. So when we take them through that process, it's about how our investment committee works, how we have found best-of-breed managers that run portfolios under discrete mandates for us, how you hold the beneficial ownership of the direct equities yourself, how you get the advantage of the, of the tax advantages of holding those direct equities. So it's a lot more sort of rigorous process. When James and I first did this, we thought our biggest issue was big clients that are giving us discretion over their portfolios. Well, they all turned around and said, well, we've got discretion anyway because we don't do anything without your advice, so giving you a bit more flexibility to make active decision-making process. And look, and that's why I say don't underestimate the power of your investment committee. And we've asked clients to come. You can come and sit in our investment committee meetings. You can come and see the process that we go through as an organisation on your behalf, and you're more than welcome to come and attend, and we're happy, and we've had people take us up on that who'll come and attend, and they'll walk away going, well, geez, that's fantastic. So it's the sales process is really about talking to clients about your rigorous, internal process that you operate to work on their behalf.
Now, are there any questions from Sydney just before we come back to so any questions from Sydney or Brisbane? So, I can't hear.
Maybe they can't hear us.
So look, one final question before we wrap up. So, yeah.
Thanks, Pat. So you charge an advice fee with your portfolio service. How do you charge your portfolio service fee, and then the impact that has on the fee disclosure statements and potentially opt-ins and whatnot?
So the question is, in addition to the advice fee, how does Paradigm charge for its portfolio management service, and what's the impact on the fee disclosure statement?
Right. Well, we operate two separate type of businesses. We've got the investment management business, MDA, and we've got our advice business. Now, we charge people an ongoing advice fee for ongoing advice, and we charge them extra for discrete, might be aged care, estate planning, whatever. Because we're the investment manager under our investment process, and we do all these things on their behalf as the investment, we charge an investment management fee, and we're allowed to charge that investment management fee. Under the class orders that exist for managed accounts at the moment, you don't have to disclose on your fee disclosure statements, you don't have to disclose your investment management fee, and that's directly written into the class orders. So the only fee we disclose is our ongoing advice fee. But make sure, and it's something I do want to say, like, I know that there's a lot of managers out there, sort of fund managers, etc., going, come and join and come under the, the managed account process. And we've been in it for a while now. What I want to sort of, I suppose, counsel everybody on is that don't sit there and think, wow, this is a great way that I can charge an extra fee to my clients and not have to disclose it under a fee disclosure statement. Because I'll tell you right now, the regulator is well aware as to the proliferation of managed accounts. They're well aware in the class orders it says you don't have to disclose investment management fees. And my sort of information that I've gleaned is that the regulator will be deeming in the future, unless you can properly show exactly the job you are doing for your investment management fee, that the whole fee will probably have to be disclosed in the future, unless you can sort of...
Yes, to that point that IMAP's had a regular ongoing engagement with ASIC, and in fact we're meeting with them next Friday to talk about various aspects of the MDA regulatory guide, and for next Friday in particular, how disclosure should be made in the initial advice. So although IMAP is, pays attention to both SMAs and MDAs, Patrick's absolutely right that the ASIC appear much more focused on MDAs and getting the regulation around those kind of refined, I guess you'd say. So we're meeting with them again in about a week's time.
Yeah.
So look, Patrick, thank you very much for your time. It's been very insightful. Please join with me in thanking Patrick for his time. And thank you very much in Sydney, Brisbane and Melbourne for attending this morning. I hope you found it valuable. I certainly enjoyed listening to Patrick and Andrew, and I look forward to you participating in future events that we run, particularly the Portfolio Management Conference and the awards, which we'll be sending you out, the details about how to participate. I am really keen for advice businesses to participate so that we can recognise what good practice looks like in a managed account environment. So thanks very much for your time and have a good day.